So now, without further delay, let's begin today's event, sponsored by Freddie Mac and hosted by National Mortgage News. It's my pleasure to introduce your moderator for today, and that is Mike Perkowski. Mike, you have the floor.
Well, thank you very much. Ladies and gentlemen, welcome to today's web seminar. We're very glad that you could take some time out of your busy day to learn more about our topic. Let's get digital. eMortgages are here to stay. Before we go any further and I introduce our speakers for today, I do want to take a moment to acknowledge and thank Freddie Mac for sponsoring today's program. We appreciate their support. Today, we're fortunate to have three speakers with extensive experience in this area and who are going to share some of their insights with you today, answer some questions, and I know will provide you with a great education about how to get more from this area. Jeff Baudet is currently chairman of the board, chief executive officer, and president of Mid-America Mortgage. Jeff has founded and successfully grown two other companies. Encore Tax Advisors was a tax lien company that he founded in 2006. Within 2 years of its founding, Encore became the largest single-family tax lien company in the state of Texas. Mr. Baudet also owns and manages Mortgage Machine Services, a technology provider that is an IT solution for mortgage companies. In 2016, Mid-America Mortgage began e-closing loans and has been e-closing in excess of 95% of its retail production electronically. Jeff was the driving force behind Texas HB 1217, allowing for an online notary commission and perform electronic notarizations by means of audiovisual communications. This bill has become the model remote online notary bill throughout the country. We're also fortunate today to be joined by Jaylene O'Brien, Senior Vice President of Mortgage Operations at NBKC Bank. Jaylene is a seasoned executive, leader, and strategist and problem solver. She leads a talented team at the bank that ensures that NBKC's borrowers get closed and serviced exceptionally well and on time. She loves to keep pace with innovation by using automation to increase productivity and to improve the customer experience. Automation of routine tasks helps NBKC achieve efficiency and ensure that the bank's customer satisfaction rating remains high. Jaylene has 28 years of industry experience and loves operational roles where she can be entrepreneurial, bring a team together to paint the big picture of where they are going, set goals, and get there. And last but not least, we're happy to have Raj Penugonda. Raj is a product development director at Freddie Mac's single-family strategic delivery, data, operations, and technology division on the product delivery team. He leads Freddie Mac's eMortgage program and is responsible for managing and improving the program. In addition to identifying and managing internal strategic initiatives, he worked closely with various industry stakeholders to increase eMortgage adoption. Raj has more than 20 years of experience in the residential mortgage industry, spanning the origination, default servicing, and secondary market sectors. Prior to joining Freddie Mac, he held roles in product management, change management, and process design at Bank of America and Wells Fargo. So these three speakers are going to cover a lot of ground. Let me give you an idea of what our agenda looks like today. We're going to go through a number of broad areas and then dive down a little bit deeper into each of them. We're going to talk a little bit about why you should embrace eMortgages, talk about some of the trends at the consumer level and throughout the industry and the various benefits of eMortgages. We're going to give you some ideas and recommendations on how to get started, implementation approaches, challenges, and best practices. We're also going to walk you through the Freddie Mac approval process for things like e-closing with no e-note, e-closing with e-note, e-closing with remote online notarization. We'll have some closing remarks, and then we'll transition into the Q&A part of our program. All right, so let's get started. This is going to be a discussion with our three panelists, and we're going to start first with the big picture issue. Okay, why should I embrace eMortgages? Raj, I want to start with you here. There was a lot of media coverage last year about eMortgages, obviously throughout the pandemic, and the popularity of that approach skyrocketed. Since life is slowly returning to what is now the new normal, where do you think eMortgages are going? Is now the time to get on board? And what are the biggest net benefits for lenders?
Hey, thank you, Mike, and good afternoon, everyone. So I would say eMortgages, meaning loans with electronic closing documents, including the electronic note, are the new normal as the consumers are looking for the same speed and convenience that they experience with their other daily interactions, which are increasingly digital in nature. So this was a trend even before the pandemic, and the pandemic has definitely accelerated the trend. And as life returns to new normal, as you put it, Mike, right, this continues to gain more traction. So there are numerous surveys done over the last couple of years that confirm this trend. But for the purpose of this discussion, I have picked 3 different surveys done by 3 different organizations at various points of time in the last 2 years. So starting from the bottom right of your screen, you see a survey done by LMA in 2019, which shows that when electronic signing options were offered to borrowers, more than 70% of them used those options. And a survey done by Closing Corp during October last year, which is during pandemic, shows that more than 80% of the consumers they surveyed preferred electronic signing options. And similarly, a recent survey done by Peninsula shows that, again, more than 80% of the survey respondents in their survey also preferred or are looking for electronic signing options from a document standpoint. So lenders that are not offering digital signing options or eMortgages are clearly missing out on meeting the consumer demand. In addition, they are also missing out on several lender efficiencies. I'll let Jeff and Jalen talk about the lender efficiencies in a minute, but I just want to share one quick anecdote or a statistic that I was looking at recently. I was recently comparing the cycle time between the Freddie Mac funding date and the note date for both paper and eMortgages. So more than 70% of eMortgages are funded in 20 days after the note date, whereas that number drops to around 34-35% for paper mortgages. So that's a huge efficiency gain for lenders that are looking for quick funding cycle time. But the good news is that there are several lenders that have recognized the consumer demand and also the lender efficiencies and have been implementing eMortgage process. In fact, currently there are 116, maybe it's now 117, lenders that have completed eMortgage implementation. And from Freddie Mac's standpoint, we have been adding on average 3 new lenders to our eMortgage program per month for the past 18 months. And several lenders that have rolled out this process have been delivering more than 30% of their production as eMortgages. And in the case of customers like NBKC and Mid-America, they have been delivering in the north of 60-70% of their production as eMortgages to us. So we see a huge adoption there. And the entry of Ginnie Mae and Federal Home Loan Banks into the eMortgage space, the growing support from various counties in the from an electronic recording standpoint, and also the policy change we did last year permitting lenders to deliver us loans that are remotely notarized in 46 states and DC. All of these factors should help the volume grow even further. So the point I'm trying to make with all these numbers and statistics is that now is the time to get on board with the eMortgage process from a lender standpoint. And Jeff or Jalen, can you share some insights in terms of what lender efficiencies you have seen with eMortgages?
The efficiencies we've seen.
I can, Raj.
Oh, okay.
Jalen, go ahead.
Okay. I would just say now is absolutely the time to get on board with e-closings if you've not already. The biggest benefit of an e-close is to the borrower. They have more time to review their docs and understand the transaction they're getting into. And since a mortgage is one of the biggest transactions that most people do in their lifetimes, it's a very good thing that borrowers have the ability to understand and read all of their documents before closing. The benefits from an operational perspective obviously are near and dear to my heart, but they definitely produce a reduced number of recloses, corrections, doc reviews in several areas, and we can sell our loans faster. It's not possible for a borrower to forget a signature, forget a date, put the wrong date, to forget what day it is. It just makes all that stuff go away and be a lot easier. Recognizing that all operations are configured a little bit differently, I would say, just generally speaking, that your closer, funder, and post-closing roles at a minimum would benefit lift from implementing this. For our operations specifically, right after we rolled this out, we added the capacity to close over 200 more loans a month, just for the conventional e-closings that we were doing. So we had great FTE savings there as well as in our other areas. So leveraging your people in a smarter way while giving a better borrower experience is definitely what it's all about. Jeff?
You know, I can echo most of those comments that you had, and we have found it to increase our efficiency dramatically. We did our first eNote in July of 2016, and currently we're doing over 95% of our conventional loans with eNotes. Actually, in thus far this year, at 10/21/21, we had funded 16,096 loans with eNotes. So we're not, we've been doing this and have found it to be much more efficient for our operations. You know, I'm going to repeat what Jaylene said about they can't close something wrong. We had actually acquired a company that was about the same size as Mid-America back in 2018. And we did that. We looked at their staffing levels, and they had 28 people in post-closing compared to our having 2 people in post-closing due to the digital signature. So, you know, and we were selling loans on an average of 10 days, and they were selling loans on an average of 26 days. And they had quality people. They were good. It was just, you know, the e-close process, you don't make mistakes, so you don't have to go back to the title company to get things fixed. It's a dramatic enhancement for the business efficiency. And that alone would do it for me. I think our customers appreciate it. We have been a little slow at moving forward on the remote online notary. We did we did several of these, and we still do probably about 6 a month whenever it works for refinances. Part of it is, you know, just the title company has pushed back a little bit on those. So we acquired our own title company and are utilizing that for the e-closings just in Texas, and it's working out very well for us. We'll extend that on to about 6 other states fairly soon. You know, if you get into the e-closing process, it's a continuous refinement of the process. And, you know, when we first started, we thought we were going to have title companies coming into our system and looking at it, but I mean, in closing within our system, and we found that didn't really work. So what we did, the borrowers were already inside our system to sign disclosures, so we just kept them inside our system for the closing, and then they did the then they did the notary piece with the title company, and that was the title company's preference because they had documents they need to sign. So they just walked into the title company and signed those. But, you know, when they went in there, it was a 15-minute process instead of the normal hour. And since we had the e-process and everything we needed, we funded that loan, you know, instantly. So the title company, the realtors love that because it's just a faster process. Ginnie Mae allowed for e-notes. It kind of had some quirky things that we had to deal with. You can't commingle paper notes and e-notes in the same security. So we backed off of that a little bit. We were doing, you know, about 40% of our Ginnie Mae production with that. We backed off on that until they get that changed where you can commingle those. Raj, that's all I've got.
Thank you so much, Jalen and Jeff. That's great benefits, right? I think I just want to reiterate what you said in terms of the post-closing efficiency, right? I think you spoke about it, Jalen. You spoke about it, Jeff. I was talking to a large lender. They said that when it comes to eMortgages, right, and compare that with the paper mortgage process, their post-closing review effort is reduced by 70% for eMortgages. So I think that's what I think you were also trying to illustrate through your numbers, Jeff and Jalen. So thank you. I appreciate that. Back to you, Mike.
Okay, Raj, thanks very much. So let's go on to our next question. I'd like to bring Jaylene back and ask her, how did NBKC approach eMortgage implementation?
Sure. So we had many customers asking for RONs and full e-closings at the onset of COVID. We had not implemented e-closings until that point. It was one of those things that we wanted to do, but you were always too busy, and that ended up hurting a bit. So we quickly pivoted to making sure that that was our number one project to complete, to ensure we were helping our borrowers where they needed it. People were understandably scared out there, and we wanted to give them a safe way to close their transaction with us. We started our implementation by educating ourselves, looked at what products and information was out there, figuring out what would work best in our environment and what would be the easiest for our teams to use. We started by doing an investor by investor approach supported by system rules to enforce what should happen on each investor once we were approved for e-notes by that investor. So we could increase visibility to what our borrower experience was going to be for everyone with the system rules as well. We then started with refinances, as we knew that we could partner with our title companies to make those happen quickly, as they were hearing and dealing with the same borrower concerns that we were. We implemented the rules in our system for those, and then we began by testing with our employee loans that we had in our pipeline. We are very feedback oriented at NBKC, so found a lot of good things to put in our process to make sure we were going to make sure that what we were going to do was very visible to everybody and clear. We did training for our teams so they knew what loans were going to be e-closings when they got to closing, and we provided our LOs with videos that showed what their borrower experience was going to be, as well as talking points. If they got asked questions about the process, they would feel comfortable speaking to it. What was very important for us was education for everyone at the bank, explaining the why, what was in it for the employees, and what was in it for the borrowers, and that was really the key. NBKC is a consumer direct shop, and most of our borrowers apply online, so adopting a closing process that used the same technology that the borrowers used when signing their initial disclosures was easy and fairly non-eventful. If at all possible, I would recommend considering doing this when you deploy your solution, as the education piece is much easier and the borrowers are already used to it. We did our first e-note in April of 2020 and are currently doing 51% of our loans with full e-close e-note. 20% of them are hybrid, and 29% of ours are still signing in the traditional in-person wet signature process. So we feel that adoption has been great. We funded about 14,000, 15,000 e-notes to date, but we've really been letting the pandemic reinforce this new concept for us. So it wasn't such a fight on our purchase business, as we got a lot of pushback on that in early of 2020. Right now, we are more comfortable with saying that it's required on a purchase now, as there are many more educated, smaller title companies out there. We initially didn't want our time savings for our closers to be spent on them educating the title companies out there, but now we feel like that's pretty much been handled, and our next phase is to make sure we're pursuing as many e-closes on our purchase pipeline. E-closes are so much more efficient for the borrowers because they can review their docs ahead of time, like I said, but we also love the borrowers spending less time in front of a notary for obvious reasons. I truly believe that being able to fully e-close is table stakes to remain in the business, and I'm very happy to see the various non-conforming investors out there adopting these right now as well. I would echo Jeff's comments on the RONs. We've only done around 3,000 of those. And that is something that we just are very comfortable with certain people doing them, but the technology really has to be there. So I would just recommend that everybody test their connections very well with their borrowers and go through their process to make sure you're really comfortable with what that borrower experience is. It is amazing when it works, but you have to make sure that you stay on top of it and understand how it's working in your shop.
Great, thank you, Jaylene. That's a Excellent overview. I'd really like to hear now from Jeff and have him tell us how Mid-America Mortgage approached its eMortgage implementation.
You know, our implementation, I mean, it came from the top. I really wanted this. I could see efficiencies throughout our operations, and I knew consumers were ready for it. They've been doing everything electronically online and trading for years and years, so this is nothing new to the consumer, so I didn't think we'd have any pushback from them at all, and we haven't. We did our first e-notes. We were pretty early adopters, so the industry wasn't quite ready for that. When we closed our first e-notes, we funded them with cash, and we found that we could sell them really fast. Within a day, we could sell the bulk of our loans to the agencies. So we kept on funding our loans with cash, and we've been doing that and kind of avoiding warehouse costs for quite some time on the conventional loans. We actually securitize our government loans. So some of the e-notes we will fund with cash, and some we will just fund on the warehouse line. So, but within the operation, I had a lot of pushback since it was new, from my employees, and just everything they pushed back, it was something that really didn't make sense. They were just kind of scared of moving forward or embracing the new technology, thinking, oh, this is going to mean I'm going to lose my job or whatever, and it really never did. For anybody that embraced it, we were able to make it work. Our policies and procedures, I mean, we counted a lot on our vendor that brought us into the e-closing process to help us develop those things, because we really didn't know what we didn't know. And as we went through it, it got to be pretty simple. And what you find, you're taking things out of your process, because there are a lot of things you can eliminate with the electronic process. You don't have to kind of check and see if something was signed properly or notarized properly, because they couldn't do it wrong. The training, the title companies, we are about a 60% purchase business in 2020, so there were a lot of title companies that the realtors preferred to use. We never even tried to draw those into an e-notary process unless there was an issue with a seller or a buyer being out of town, and then we made our platform available to do that. And I think Jaylene is absolutely correct that not every computer, not every borrower are set up for a web closing, and that you'll have some technology issues. So you've got to debug that first to make sure that the borrower can do that. And I don't know. I'm not sure that we'll ever get the title companies to do the e-closings effectively, within their own systems or embrace what we do. But it comes down to when there's a crisis, they'll embrace it and we go forward, and they get that closing done. So I think that once they figure out it's better, they'll embrace it. As far as security, actually, the guy that helped us, the attorney that wrote the remote online notary bill in Texas, was on the other side of a transaction with me, and the largest credit at this little bank that we were looking at was that failed was a falsified notary, and so that was just made it really interesting as we were developing that law, trying to figure out how to make it secure, and who that borrower is. And John Fleming, who did that, did an outstanding job to make sure that the title companies were happy with it. So that's why that became the kind of the model bill to go forward, and it was all John Fleming, not much of Jeff. And I can echo what Jaylene said about the first closings. Make sure it's somebody that knows you well. I think my brother has just forgiven me for our closing debacle we had on that loan, but we figured it out, and you learn from your mistakes and move on. That's all I got. Thanks.
Okay. Thank you very much, Jeff. Jeff, we're going to stay with you, but I want to hear from Jaylene as well when we go to our next point here. And that is, Jeff, based on your experience, where should lenders start the conversation? Do you have any implementation challenges and best practices that you could share with the audience? Jeff, not sure if you're on mute.
I'm sorry. We had a lot of issues moving forward when we first started out. The vendor we worked with was familiar with what we were doing, and as we talked through all of the potential problems, they helped us out. I think one of the issues, we didn't have our documents where the borrower could mark, a veteran could mark whether they intended to occupy the property or something in a checkbox, and that took us a while to get debugged. So we had challenges with our technology that we had to enhance to move forward, and we did that. But your vendors should know all those issues, and there are some advisors out there on e-closings that are really good that can help you get lined out. But frankly, it's really just skipping processes is what it is, and making sure that you have whatever the borrower is going to close. That process needs to be complete, or your vendor needs to have a way of doing those checkboxes or whatever variations that need to be done in order to make it effective.
Great, thank you. Jaylene, how about you?
I would say start your conversations with people with terminology in mind and really try to understand what people are talking about. I think it is a lot better now, but I found that people were using the same terms and meaning very different things when they were trying to sell me something or talk about our process. So you need to be very clear as to how you define what you're talking about with your various vendors, as well as internally, to make sure you keep everyone on the same page. And frankly, deciding which part of this process you want to use for second and third, and maybe there's something that you might not want to use at all when on your first blush. I would also say, as a best practice, I would analyze the various systems and products out there and look at integration points. I would really say that you want to minimize your potential breakage to your platform, your reconfigurations, releases, all of that. So minimize your vendors as much as possible that you're going to rely on to implement this process to make sure it goes smoothly and there's not a lot of maintenance involved. And then finally, if you are just sitting there going, I don't even know where to start, which is where I was when I got my first phone call, the investor approval requirements out there are very well documented and have been, as well as your MERS requirements. So that is a really good place to start and combine your checklist to get you started on what you need to understand, what you need to make sure you understand, and what needs to be deployed within your shop to make this work.
Great, thank you, Jaylene. All right, so let's talk specifically about Freddie Mac for a minute. Raj, I'd like for you to give the audience an idea of what the approval process is like at Freddie Mac for eNote and RON acceptance. And in the approval process, are there any steps that lenders get tripped up on regularly? And for lenders who had the smoothest approvals, do you have any tips to share with the group?
Yeah, definitely, Mike. So from a Freddie Mac approval standpoint, right, if lenders are looking to deliver loans with the electronic closing documents, whether the closing occurs through a remote online notary process or a in-person electronic notary process, there is no approval required unless the closing package includes an electronic note. Right? I just want to make sure people are aware of it. So the approval is required only when you want to include electronic note in the mix. So for those lenders that want to include electronic note and deliver such loans to Freddie Mac, the approval process is really focused on verifying lenders' technical and operational readiness. So by technical, what I'm talking about here is the lender's eNote system, the e-closing system where borrowers sign electronic closing documents, including the electronic note, the eVault system where the borrower signed electronic note is securely stored. And most lenders use Freddie Mac reviewed e-closing, eVault, and eNote systems. But if a lender wants to set up their own proprietary platform, or if they want to do heavy customization to a vendor solution, right? In those cases, the review process will start with the demo and the security review of the platforms. But as I said earlier, most lenders do use Freddie Mac reviewed eClosing, eVault, eNote systems. In those cases, we start with the testing step, which is to verify that the eNotes created and delivered by the lender's platform are rendering properly within Freddie Mac's eVault. In addition, this testing also includes through this step we are trying to verify if lenders are able to report life of loan events that occur during loan servicing, such as loan modifications or payoffs, etc., to Mercy registry. And lenders need to provide us documented procedures that cover these life of loan updates as well. And for lenders that are using sub-servicers who have already given us these procedures, this step is not applicable, but we want to verify that there is a sub-servicing agreement signed between the lender and the sub-servicer. And if a lender has to create these procedures, we have several templates we created that could be used. And these templates are created in such a manner where all the information is pretty much filled out for the lender. They just need to complete maybe their system screen name, etc. So it could take maybe half an hour or 1 hour for them to create this procedure. So we try to make it as easy as we can, in terms of the servicing procedures. And for those lenders that do not retain servicing, appropriate servicing release forms need to be signed with the servicing buyer. And some lenders use warehouse funds to fund their eMortgages, in which case the warehouse lender has to be approved with Freddie Mac. We have currently 30 warehouse lenders that are approved, so which is almost, I think, say close to 30% of all the warehouse lenders we do business with. Right, out of that, 30% of them are already approved for eMortgages. So the chances are a lender should be able to find a Freddie Mac approved eNote warehouse lender to fund their eNotes. So all in all, the approval process takes less than a week in most cases. But you asked the question about, you asked for two different scenarios, right? One is the smoothest approval process, and then the other ones where people take a long time, right? So I'll start with the worst case scenario, which is we have seen if lenders reach out to us only after they complete implementation, and they say, hey, we want to use warehouse lender XYZ, servicing buyer ABC, right? And if the servicing buyer or warehouse lender are not approved with Freddie Mac already, right, or they're not ready for eMortgages, then that means now they have to go back to drawing board and start the process of figuring out whether they can use one of the Freddie Mac's approved eNote warehouse lenders, or they have to wait until the warehouse lender is approved with Freddie Mac to fund eNotes, right? So that is one of the common things that happens, but it is now infrequent. It used to happen a lot a couple of years ago, but it is infrequent because now people are aware that they need to talk to us before they start the approval process with us. The smoothest approvals are the ones where, as lenders start thinking about eMortgage implementation, they engage us because we are not simply approving customers, right? We can be part of as a process consulting team that is willing to support lenders on their process design. We actually visited a large lender site and we spent 2 days there mapping end-to-end process, right from loan application all the way through post-closing and servicing. So we try to do the end-to-end process mapping, with their help, and try to identify the points that need to be changed for eMortgage implementation. So the smoothest implementations are those where lenders reach out to us early on during their implementation process and talk to us and understand our guidelines. So that is what I would say as my recommendation in terms of ensuring your implementation is smooth.
Excellent. Thank you, Mike. Very good. Okay, so we've covered a lot of ground so far. I'd like to have our speakers give some closing remarks here, specifically to the following. And Raj, we're going to start with you. So eMortgage adoption is obviously growing, but it's still a very small part of the overall market. What needs to change to have lenders ramp up eMortgage production? Raj, you first.
Thank you, Mike, again. So eMortgages currently account for 5% of overall volume we purchase today. So in comparison, this was less than 1% a couple of years ago. So we have made huge strides from a adoption standpoint and volume standpoint. But if I have to think of some barriers that are limiting the adoption to an extent, I would pick three. The first one is the lack of uniform adoption of electronic recording and electronic notarization across the country, due to which lenders having to determine, based on subject property location, which loan documents they can have the borrower electronically sign versus which ones need to be wet signed. So that creates operational complexity for some lenders, and that limits adoption, from a scalability standpoint, right? The second major barrier I can think of is not every aggregator is still purchasing e-notes, and that definitely impacts those lenders that are not directly selling to Freddie Mac. And then the third barrier I can think of is the lack of seamless integration between the doc platforms and then e-closing platforms. The impact of this is that when a document is generated by a document provider's platform and is fed into the electronic closing platform for signatures, right? The signature elements are not tagged automatically by the e-closing platform, meaning that a settlement agent would have to now sit and try to manually tag those signature elements. And that, means a settlement agent had to probably spend more time on a e-closing compared to a traditional paper closing. So in most cases, settlement agent is simply going to print out the paper and have the borrower wet sign. But the good news is several e-closing providers have recently been rolling out enhancements to their platform that basically the technology is called auto tagging. So what this means is that regardless of which doc vendor creates documents, right, those documents can be fed into these e-closing platforms, and these platforms are designed such a way they can detect the signature elements and auto tag this properly. So say a settlement agent doesn't have to sit and tag those manually. So that is something which is happening for the past, I would say 8-9 months or so. And as technology evolves, right, this should be less of an issue. And in fact, Freddie Mac has been working very actively with various technology providers over the last couple of years, trying to educate them on the need for such technology. So that's my viewpoint. Not sure if Jeff or Jalen, you have any thoughts?
Excellent. Go ahead, Jalen.
Go ahead, Jalen.
Sorry. So Raj, I would agree on the title company part of just the efficiencies, but I actually think that it also, it's much more efficient as it sits today. Education is just lacking out there for a lot of folks. So the purchase title companies that I've talked to, they're on board, and they really talk about giving the realtor less control in transactions, and they're really proactively talking about how much better this is, because they know they can close 4 loans for every one they used to close when they're using this method. And that's a lot less realtors screaming at them because they can't get their purchase in on a Friday. So it really is a lot of education that still needs to happen, in my opinion, on the realtor side as well as the title company side to get the adoption up. Because any of the technological efficiencies, they will continue to evolve and get better, but there's really, really good efficiencies out there right now for everyone. The other issue that I see is really just we need all investors to adopt and accept e-notes on a regular basis, not as a pilot program or on a test basis. So lenders can really do them 100% of the time. I don't want to discriminate against borrower A and give them a worse experience than borrower B because I know this investor, I need to get this loan to, won't accept e-notes. So it really, in my opinion, boils down to education in various parts of the market. And I do feel like it's getting there. And like I said earlier, we are more comfortable in requiring e-notes where we can on purchases. So that's really, really exciting and a good first step. I was very pleasantly surprised when I talked to a few of the smaller title companies like they're all about it and very excited. So I hope that will continue, and everybody just really sits down, does the math, and realizes how much better it is. Jeff?
Jaylene, that's a good comment. I don't think we have worked hard enough to get title companies to embrace this, and I think we will do reach out to try to get that accomplished. One of the things that we're a large government lender. We do a lot of Section 184 loans, which are for Native Americans, and with that, Ginnie Mae, they have we have difficulty aggregating enough size of our loan pools to make that work, and they don't allow the commingling of the e-notes and the paper notes. So that's a big one. If they would allow the commingling of those documents, that would really speed things up in the process or help us greatly on the e-notes. And to echo what Jaylene said, the more servicers and sub-servicers embracing e-notes, frankly, it's so much easier. Your doc custodian is actually Freddie Mac, and the notes never get lost. Moving them about, it's just so much faster and easier. So it's so much easier for the servicer once they embrace it. But I think it's the thing that they don't know how to do something different and don't want to change. I think SnapDocs is working on a API that will share with investors and I think like the various counties, and just give you an API as to where you can do a remote notary and make e-closings easier. But really, remote notary is the only thing that is a barrier, and that's really very limited. I think there are just 4 states which don't allow RON processes, and I think we're working on that. There is a federal bill moving that may be attached to Build Back Better that will be able to allow. I think it's called the Secure Act, and it will fit in with. Hopefully, it will pass with the Build Back Better bill. So that could all open up fairly fast as well. That's all I've got.
Yeah.
Thanks.
Okay, thank you, Jeff and Jaylene. So I think with regards to title agent comment, I just want to make sure we are right. So there is definitely increasing willingness from title agents to participate in the space. We have Fidelity National Financial, First American, Stewart, right, and then Westcore. A lot of these people are already, willing. And then, Jaylene, you pointed out some local title companies are eager to participate as well, right? So there is definitely no lack of appetite from their standpoint. The issue I have seen in some cases is where because of the lack of compatibility between the e-closing platform and the doc provider, the docs that are fed into the e-closing platform are not auto-tagged. So on the day of closing, right, somebody had to sit and tag those documents manually. So when such issues occur, those issues discourage the participants from using the process, and that is now becoming less of an issue because, as I said earlier, right, more and more companies like DocMagic, etc., are already rolling out. I think you mentioned the SnapDocs, right? SnapDocs. I think a lot of these platforms like Notarize, a lot of these platforms have a auto tagging functionality that enables any document coming from any doc platform to be auto tagged for signatures, and that reduces stress on the back end of the process. So all good stuff. So back to you, Mike.
Okay, thank you, Raj. We are going to take some questions from the audience now, and for those of you who submit a question we don't have a chance to get to, don't worry, somebody will get back to you after today's program. All right, so let's get into a few of these questions. Raj, the first one is for you. Our audience member wants to know, why can't I just e-sign a PDF of a promissory note? What makes e-notes special? And are you seeing lenders request a title agent just e-sign their PDF note due to COVID?
Yeah, this is definitely something that a lot of people asked us last year because everybody was trying to figure out a way to digitize their closing process, and they thought they can just do a PDF e-note, right? But this is not really a question that we are fielding a lot recently, but we definitely fielded this a lot in 2020 at the height of pandemic. But to answer the question, I think I need to start with paper promissory notes, right? So paper promissory notes, as many of you may know, are meant to be negotiable instruments. So the equivalent concept of negotiable instruments in the case of electronic signature laws is a provision called transferable records. So for an electronic record or document to be a transferable record, right, it has to be unique, authoritative, and unalterable. Right, so industry has created a technology framework, which we now call MERS registry, right, which is a centralized registry of all the e-notes to address the unique and authoritative aspects of the transferable record requirement. And then when it comes to the unalterable aspect of the, of this, requirement, right, industry has come up with this technology framework called a smart document. A smart document is a tamper-evident document, meaning that if somebody tries to make a change to the document after the borrowers sign it, the stakeholders can detect that the document has been changed. So for these reasons, right, a electronic note has to be a smart document, which is a requirement of all the major investors, including the GSEs currently.
Great. Let's go to our next question. Jeff or Jaylene, I'll let you fight this out between you. Our audience member wants to know, what vendors have you seen the highest success with?
So
Jaylene, go ahead. You go ahead, Jaylene.
Okay. We are in Encompass Shop. We use DocMagic for our documents. So that is the company I was referring to when I was talking about, implementing our eClose service. We don't pop around and use a lot of different technologies. We use DocMagic, and that's what people use if they're going to close with us via eClose. So I am not a proponent of adding a whole bunch of different things into our current platform because it just gets a little bit convoluted and more confusing. I do believe that title companies are becoming more on board with, they have to provide eClose and RON as part of their offering, or they're not going to be around for long term. Our title companies that we do business with go in via DocMagic, and they have their own RON platform that we test and vet to make sure that we're good, or we don't allow them to close via RON. We just let them do eClose. So it goes through that same main platform, and then the RON piece is the second spot that we were talking about, that it needs to be really, really fully tested because it's a lot more technical and complicated to get a borrower on board with that. Jeff?
We started with DocMagic as well, and I think, they tag the documents up front, and I would say if you have a doc prep firm that's not willing to tag documents, I wouldn't move forward on the e-closing process with them. I would look around for others. They'll all do their best to make it work. There are many vendors out there that have gotten up to speed since we developed and started doing this. But we were kind of out front to make it work. And DocMagic changed their platform numerous times in order to accommodate some of the things we were trying to do. And it's pretty slick now. You've got Evolve is out there. I think most all of the doc prep companies have kind of moved forward on this, and I think they actually tag the documents. So there's plenty of great vendors out there to make it fly, but just pick the right one for you.
Good. Jeff, we're going to stay with you for the next one. It's actually two related questions. So the first one is, do all states accept eMortgages at this point? And then the related question is, which states have you found to be the easiest to work with on e-closing?
We do e-closings in every state. The node is fine with whatever you're doing. Actually, we're not licensed in Vermont, and we don't do retail production in New York. But I don't think there'd be a problem in either one of those unless Now, there are 4 states that have not embraced or that will not allow the RON notary piece, but I wouldn't let that stop you because that's you've got more borrowers' computers out there that won't let you do the the remote online notary than you have states being an issue, I think. And as I said, I'm pretty confident that the Secure Act is going to fix that before you can get up to speed.
Hey, okay. Mike, can I jump in on that question also?
Sure, please do.
Yeah. So as Jeff said, right, eNotes eNotes can be done in all states and DC, right? So throughout the United States, you can do eNotes. And what Jeff was talking about is the remote online notary process, which currently we do not permit in 4 states, including California, for various reasons. But so if somebody is looking at just doing eMortgages, meaning loans that include electronic note, you could do this across the country. From a RON standpoint, from a remote online notary standpoint, we are seeing a lot of volume from Florida, Michigan, Arizona, Virginia, and Illinois, Pennsylvania, right? So I'm not suggesting these are easier to do or anything, but I'm just trying to share some information on where we are seeing most volume from a remote online notary standpoint. But eMortgages, as Jeff said, we see volume throughout the country. We are purchasing eNotes from lenders across all 50 states and DC.
Great, thank you, Raj. Jaylene, let's go to you for the next question here. Audience member notes, when borrowers receive documents prior to signing, the LOs get questions they don't know the answers to, and the calls can be an hour long. How are companies handling this?
Well, that has not been our experience. Our LOs know what's in a closing package. It's required that they review it and they know what their borrowers are signing, so it's not really an issue. Our LOs for the past couple of years have not seen more questions on an e-close versus a normal close. I think a borrower is always going to have questions signing a note for a very large sum of money. So that's okay. And that's what your sales guy is there to talk them through and make sure they're comfortable. If it takes some folks an hour, I would just, if that's a concern, I would just sit down and understand kind of what the LO is not understanding about the closing process is what I would say. I don't see a lot of that here.
Very good. Thanks, Jaylene. Raj, let's go to you. A very straightforward question from our audience. They want to know, how long does it take to implement eMortgages?
Okay. There are no straightforward questions in eMortgages. I'm just joking, sorry. So I assume the question is focused on e-closing and eVault system implementation, right? So if the lender is trying to build a proprietary e-closing eVault system, or they want to do heavy customization to a vendor solution, implementation could take several months. But most lenders use off-the-shelf solutions, and in such cases, the implementation takes typically 45 to 60 days after a vendor contract is signed, based on what I have seen. However, the implementation of systems is only one piece of the overall rollout process. So before even lenders select the e-closing and eVault system, we recommend them reaching out to their business partners such as warehouse lenders and servicing buyers to make sure they are ready to support eMortgage transaction. And we also recommend them researching their markets to determine if they can digitize all loan documents or if they need to have some documents wet signed by the borrower. And then also in parallel to their implementation, we recommend lenders to work on their closing and servicing procedures to make sure those procedures accommodate eMortgage processes. And then one last thing I would want to mention is as part of the rollout, lenders need to set up closing agents and notaries in the reclosing platform, or they need to train their employees. So if all of these aspects are taken into account, from an implementation standpoint, right, then I would say overall it could take maybe 3 to 4 months. Not sure if Jeff or Jalen agree with me. Jeff or Jalen, do you have any different thoughts?
This is Jeff. It's not fair of me to do this because we did it before, back in 2016. It was a little early, and I think it took us about 4 months to figure it out. But I think that time has been compressed dramatically since then.
Yeah. I agree. Jalen, any thoughts?
I would just say thank you, Jeff, for figuring it out and going through that. Because by the time we did it, it took us 30 days. By the time we downloaded all the checklists, talked to MERS, talked to the agencies, everything was very well documented out there as to what we needed to do. So it was good.
All right. Well, that does conclude our program for today. I want to thank our presenters, Jaylene, Jeff, and Raj, for sharing their ideas, their insights, and for answering your questions. As I said, if there are some questions we couldn't get to, someone will get back to after this program. And once again, I do want to acknowledge and thank Freddie Mac for sponsoring today's program. We appreciate their support. And last and not least, we want to thank all of you who did attend this program. We're glad you could spend some time with us and learn more about this topic. And we hope that you will join us for a future web seminar brought to you by National Mortgage News and its partners. So on behalf of your host, your sponsor, and your presenters, thank you all for joining us, ladies and gentlemen. We hope you have a great and safe day.